Today we're going to talk about stock compensation plans, what they are, what their purposes are, and some of the accounting and reporting issues that work around those. So stock compensation plans usually are in the form of stock options. Is how they're granted. They grant to key employees the option to purchase common stock at a given price over an extended period of time. So, for example, the option says that the employees can purchase the stock at $10 a share for 6 months, a year, 2 years. And they have so many options. The options will define the quantity of stocks that the employee can purchase. Stock compensation plans, as a part of the overall compensation plan in an organization, really help contribute to some of the other things that we need our employees to do. So, for example, we need the employees to show up every day and just do the basic job. Let's keep things going. Let's keep things moving. A lot of our base salary, our base wages are focused on keeping the company going. However, a really effective compensation plan also has some elements that are based on performance, that say the better you do, the more you'll be paid, which helps to motivate our employees to a higher level of performance. Our compensation plans at an organization are created and formatted in ways to help keep executives, especially key executives, and also to help us recruit new talent. We're seeing a lot of evolution in compensation plans because there are new demands on an organization that weren't there before. Employers want to maximize the employees' after-tax benefits and minimize their after-tax costs. And they want to tie things to performance criteria that are measurable and over which the employee has control or contributory efforts towards. So let's just take a minute and think about that. When we offer the employee the ability to buy into the company so they can purchase equity shares, we are giving them a piece of the pie. We are giving them the opportunity to have a stake in all of it. This fosters the buy-in perception that we are looking to create within the organization. In your book, you have illustration 16.3. Now, as you can see here, there has been quite a shift from providing stock options as a part of the compensation package to moving to restricted stock grants. Some of the reasons for these change are that historically, there's been a lot of criticism about providing lots and lots of stock options, especially to key executives who then would, in theory, have the motivation to manipulate the accounting numbers to yield results that would grant them more stock options, or that would increase the market value of the stock so that they could sell their shares and realize a capital gain. Because of the manipulations to achieve a higher sales price, stock options themselves have really come under fire. One of the things that companies have decided to do instead is cut that back and start issuing restricted stock. We talk about that a little bit more in depth later. Just know that we're seeing that between the manipulation possibilities and the new GAAP guidance that requires companies to record a higher expense when the grant options are actually granted, not necessarily exercised, that companies are moving away from issuing as many options. They are transitioning more towards using the restricted stock grants. GAAP requires that companies recognize their compensation expense based on the fair value of the stock options expected to vest on the date of the grant using an acceptable option pricing method. Using the fair value method, companies use their my apologies. Based on the vesting. So there's a couple of models, option pricing models. GAAP requires the use of the fair value model. So let's start with looking at recognizing stock compensation. There are two issues. There is the actual determination of what the expense is, and then there is a period of allocation for that compensation expense. Determining the expense. When we're working on what is the expense, under fair value, companies compute the total compensation expense based on the fair value of the options that are expected to vest on the date they grant the options to the employees. This is called the grant date. We allocate these expenses, recognize it in the periods in which the employee performs the services. This is our service period. Both of these are really important for us to understand so that we can allocate these expenses appropriately. So to illustrate that, let's look at Searle Company. Searle Company. On November 1st, 2016, the stockholders of Searle Company approve a plan that grants the company's 5 executives options to purchase 2,000 shares each of a company's $1 par value common stock. The company grants the options on January 1st, 2017. The executives may exercise the options at any time within the next 10 years. The option price per share is $60, and the market price of the shares at the date of the grant is $70 per share. Under the fair value method, the company computes the total compensation expense by applying an acceptable fair value option pricing model. The fair value option pricing model determines that Searle's total compensation expense to be $220,000. So let's look at what some of the basic entries are in regards to this stock compensation plan. So we have to make some assumptions that we're going to be given for Searle, because we don't have all of the detail information regarding these options and grants. So we're going to assume the expected period of benefit is 2 years, starting with the grant date. Searle would record the transactions related to this option in this way. On December 31st, 2017, they would recognize compensation expense of $110,000. This is $220,000 divided by 2. Then they would credit paid in capital stock options $110,000. Now remember, we received the $220,000 by using a fair value option model. Then on December 31st, 2018, the other $110,000 would be recognized as a compensation expense, and paid in capital stock options would be credited the remaining $110,000. Now we've granted these options. This doesn't mean that they have been exercised yet. Now, if Searles executives exercise 2,000 of the 10,000 options, so 20%, on June 1st, 2020, 3 years and 5 months after the date of the grant, the company would record the following entry. Remember, it granted them to purchase at $60, so we receive cash in the amount of 2,000 times 60, or $120,000. We would debit paid in capital stock options, $44,000, and then common stock would be credited $2,000. That's 2,000 times $1 par value, and then the remaining $162,000 would be recognized as paid in capital in excess of par common. Now, what you're probably wondering is why $44,000? Remember, this is 20%. 20% of the $220,000 fair value allocated to the original option is the $44,000. We're moving that out of the paid in capital stock options because no longer will $44,000 of it be an option. It has now been exercised in the form of $120,000 worth of cash. Now, often the case falls around that not all of the options are going to be exercised. So if Searles executives fail to exercise the rest of those stock options before the expiration date, then the company will record the following at the date of expiration. They would debit paid in capital stock options, the $176,000 that remains related to that grant. And then they would credit paid in capital expired stock options, $176,000. Now, just as a note, companies do not adjust the compensation expense upon expiration of the options. However, if a company forfeits a stock option because the employee fails to satisfy a service requirement, so they've left the company should adjust the estimate of compensation expense recorded in the current period. Remember, a lot of things surrounding accounting deal with estimates. Before we move on to restricted stock, I just want to talk to you a little bit about things such as vesting. So vesting is occurring on the date the employee's right to receive or retain the shares is no longer contingent on remaining in service to the employer. This is something that happens often. They have a right to purchase it as long as they are employed. If there is a vesting option and it continues beyond the point of employment, then there would not be an adjustment. Stock options can also be issued to non-employees for goods or services, and they are also recognized using the fair value method. On the date of the grant, so on January 1st, 2017, you'll recall that we had no entry. However, as we moved through the service period, we allocated appropriately the amounts that were expected and estimated based off the fair value model. Now, I talked a little bit about restricted stock plans when I told you that companies are moving away from stock options and transitioning more into restricted stock plans. Restricted stock plans transfer shares of stock to their employees, subject to an agreement that the shares cannot be sold, transferred, or pledged until vesting occurs. Now, remember, vesting occurs on the date that the employee's right to receive or retain the shares is no longer actually tied to their continued employment with the organization. Some noted advantages of restricted stock is that restricted stock never becomes completely worthless. Restricted stock generally results in less dilution to existing stockholders, and restricted stock better aligns the employee incentives with the company incentives. Because it is tied to continued employment, and the employee must remain employed, there is less of an incentive to engage in fraud. Fraud will eventually be caught. They cannot maximize share market value of the shares and sell it at any given point in time. With restricted stock, of course, there are some accounting issues, and we're going to go over those. The first part is that we have to determine the fair value of the restricted stock on the stock date, or on the grant date. So using a Skidmore company who issues 1,000 shares of restricted stock to its CEO, Rail Stalker. Skidmore's stock has a fair value of $20 per share on January 1st, 2017. The service period related to the restricted stock is 5 years. Vesting occurs if Stalker stays with the company for a 5-year period. The par value of the stock is $1 a share. So let's look at the entries and how this works. With restricted stock, on the grant date, January 1st, 2017, we would debit unearned compensation $20,000. And we would credit common stock $1,000 for par value of the common stock. We would also credit paid in capital in excess of par an additional $19,000. We are posting to the contra equity account unearned compensation to represent the cost of the services yet to be performed. This is not an asset. Now, through the course of that service period, so we started on January 1st, 2017, it's 5 years. On December 31st, 2017, we would need to make an adjusting journal entry to record the applicable compensation expense. We debit to the compensation expense the amount attributable to this year. So remember, it was $20,000 in 5 years. Therefore, 1/5 of it, or $4,000, represents compensation expense for 2017. And then we credit the unearned compensation. Skidmore will record compensation expenses of $4,000 for each of the next 4 years till it is accounted for the full amount of the restricted stock grant. Now let's make another assumption and assume that Mr. Stalker leaves on February 3rd, 2019, before any of the expense has been recorded for 2019. We have to make an adjustment, and we would debit common stock, $1,000. We would debit paid in capital in excess of par, $19,000. Because remember, this restricted stock was contingent upon his continued employment for the 5 years. We then would credit compensation expense, $8,000, for the 2 years that have been recognized. And we would credit unearned compensation, $12,000. Restricted stock has a lot more entries tied to it, but the format of the plan is more in par for transparency, integrity, and tie-in of key employees to the strategic initiatives of the company in the long view. So included in other types of employer-employee stock compensation types of plans are what are called employee stock purchase plans. So this is when the employer allows the employer allows the employees to purchase the stock at some type of a discounted price for a short period. Generally, these plans are going to be considered compensatory, meaning there's going to be a compensation expense attached to them, unless they do satisfy all of these conditions. One, substantially all full-time employees have the right to participate on an equitable basis. The discount from the market is small. So if the discount from market price, when they create their employee stock purchase plan, they write it as whatever percent less market value. If that discount percentage is small, say 5%, then that is a satisfactory for small. However, many of them are written around 15%. The 15% is not a small discount. The 5% is. It basically just accounts for the difference that the company would have to pay in their issue expenses if they were to send it out to public issue. And if the plan offers no substantive option features. Many companies do have these because they are considered compensatory most of the time, because the discount is typically higher than the 5%, what they would save from going to public issue. We may see a phase out of them as an attempt for organizations to trim their expenses. When a company has any type of a stock compensation plan, there are absolutely disclosures that have to be made. Companies with one or more share-based payment arrangements have to disclose the nature and the extent of the arrangements, the effect on the income statement of compensation costs, the method of estimating the fair value of goods or services received, or the fair value of the equity instruments granted or offered to grant, and what cash flow effects they have. Remember, there's one thing that we deal with much in accounting, and that is often significant disclosure, because these are things that may or may not impact the decision making of a stakeholder.